So just to introduce, got Brian Henderson, Director of Consulting from Mercer, David Farrar, Senior Policy Manager, Investment and Governance from DWP, and Shri Krishnansen, from Strategy Director from Smart Pension. My name's Lizzy Holliday, I'm from the PLSA, I'm the Head of DC Master Trust and Lifetime Savings. So there's quite a lot to cover in this session. We're going to be doing a short introduction on the current work the PLSA has done on the landscape as it is now. We'll then also be doing some live polling as well, so have your app ready to answer some of the questions that we'll be going through, and then the panel will be discussing some key issues. The app is also available for you to ask questions, and there's also the opportunity to ask questions via the live web stream as well, via that means. So please do send your questions in as we're going along, because we'll be feeding those questions into the discussion as we proceed, rather than waiting until the end. So looking forward to lots of challenges there, mainly for the panel rather than myself. So looking forward to that and hearing all those answers. The other thing is to remember also to be tweeting as well about the session, and then there'll be kind of a survey at the end of the session as well. So without further ado, just wanted to share a little bit about the current landscape as a bit of context before we leap into the discussion. So as you may well be aware, there's some forecasting around the DC asset under management, which is set to grow to 1.7 trillion by 2030. We know from TPR surveys that 99% of scheme members are in the default fund. Obviously that varies across different schemes depending on their shape and size, but the generality of it is 99% of members are in the default. It's also an interesting time in terms of the general context, so lots of policy developments happening this year. We're looking to be headed into a review of the charge cap, which David might be able to talk a little bit about later on. We've got the next steps coming up on the illiquid investment and patient capital. So there's been a lot of movement around this in 2018 and 2019. The HMT patient capital review is still rumbling on, with the Conservative manifesto commitment to unlock pension scheme investment in scientific discovery. We've got the DWP's consultation on illiquid assets, which was conducted last year, seeking to reduce barriers to scheme investment in illiquids. And there'll be further consultations in this space as well coming forward, for example, on performance methodology. So there's a lot to look out for there as well. Obviously, ESG and stewardship. So we've got the next steps of the 2018 and 2019 changes to scheme disclosure on shareholder engagement and implementation statements. And then we've also got the TPR review. So they've undertaken a thematic review of investment governance of the default last year. And we're going to be seeing next steps coming through now, and we're waiting the published findings from that. So obviously there's an awful lot going on, but we do still have some gaps in the available data. So to help support some of that, PLSA has been conducting a default investment research. So Caroline Escott, our policy lead on investment, has been leading on this area. So there's been quite a thorough literature review conducted, and then that fed into a member survey, and that will be followed up with various one-to-one interviews as well. We're particularly interested in finding out more about some of the non-published information, so particularly about a non-master trust section of the market as well. So we've been focusing the survey on single employer trust-based schemes, and we've covered quite a few issues. So there's a list there of things that we focused on. So the asset allocation in accumulation phase, the investment governance, approach to risk, benchmark use, and the approaches to decumulation. And we've had kind of a varied depth and breadth of answers to some of those questions, which we can explore some of those issues a bit more in a moment. So we had just under 35 schemes responded to the survey, including some non-master trusts, and we're following up with lots of one-to-one conversations. So there's a lot more rich data still to come and feed into this. And then we're aiming to publish a report in summer 2020. But in the meantime, we do have a little bit of a sneak preview into some of the findings that we have so far. As I say, we're digging into these a bit more, so there will be this will raise some questions possibly that we may not have the answers to right now, but we are digging in with further one-to-one interviews. But in summary, the emerging findings are looking like this. So under investment governance, we've got a few sort of maybe surprises in that. So 13% of schemes haven't reviewed the default approach for more than 2 years. So given the changes in the landscape over the last couple of years, we might have expected the 13% to be a rather lower figure. There is a high proportion of schemes, obviously, that have reviewed within 3 years, but we're digging into the one-to-one interviews to kind of find out a little bit more about what that might be, what the barriers are, what the reasons for are that. We also have several figures in the next line. So just under half of schemes are spending 75% of their time on default versus self-select. So in one way, that might be quite a surprising statistic because we might have expected a higher proportion of schemes to be spending a high proportion of times on the default. But I think this also reflects some of the different size and shape of schemes that the survey covered. And again, we'll be able to report more in the summer about that once we've done the one-to-ones. And another sort of slight surprise is the 24% on the don't know the analysed 3-year return. So there are things we need to dig into, things we need to find out more about, and we're in the process of doing that at the moment. So the other results from the emerging finding are around the variety of de-risking approaches. So some of these only de-risked a few years on the approach to retirement. Other schemes, it was 15 years out from retirement. Again, some of this will depend on the proposition of the scheme in relation to decumulation and how they manage that through. Some of that will depend on the balance of the spread of investment in the scheme in the earlier phases as to how far adjustments need to be made further out on the approach to decumulation. On the decumulation question, we've got 83% of members that refer to external providers. So obviously this is having quite a big impact in terms of what happens to the investment patterns on the approach to retirement. And there's some really big questions there about whether or not that's the right thing. So as well as work on investment and on the DC default research, PLSA is also doing a lot of work around decumulation opportunities, looking at the FCA investment pathways and thinking about what should the trust-based sector look like. What would the framework look like that would help the trust-based sector be delivering something similar to support members in this space? And we've got some polling questions on decumulation as well, so we'll be able to explore some of those issues as we go forward. So without further ado, I'm going to skip into some of the polling questions now. We'll do a couple of those and have a little bit of a discussion, and then we'll do another couple of questions which are on decumulation, and the third set of questions will be on ESG. So, have your apps ready. So the first question, so is it a good thing that 95% of members are in the default arrangement? So it'd be great to have your views on this. Obviously, default fund having sort of associated with automatic enrolment, looking to get members into a fund where they don't need to make an option, trying to use inertia, trying to make sure that risk is managed for the generality of the members. So do we think the fact that 95% of members are in the default arrangement is good? Yes, no, or it's neither good nor bad? Is anyone having trouble with the app?
3 people aren't.
Oh, thanks, Craig.
Quite a shift. Sudden surge of yeses.
Ooh. Okay, just give it a few moments. So kind of got quite a relatively even spread there. So neither good nor bad is leading at the moment, as you can see. Quite a few people think it's good, but 21% think that it's not good. So it'd be interesting to get in and underneath what that might mean in terms of what's happening in the landscape, what those funds are looking like and what some of the pros and cons are. So that's staying fairly static. So I think I'll move on to the next question. So question number 2. So what percentage of people will be invested in the default in 5 years' time? So we know it's very high percentages now. Where do we think that that's going to go? Range of options there. So do we think it's going to carry on the same trajectory? Well, hey! Is that the real answer? Any other shifts? Okay.
Blimey.
That's really interesting.
Yeah.
That's one person.
Okay, so there's a problem with the app. Are you able to get into the question? Yes. Are you able to select the answer? Okay, so we'll just pause for a moment.
Show of hands.
We could do a quick. Ooh. May I take a little bit of a poll by people raising their hands while this feeds through? So if you could select just one answer. So who thinks that it will be more than 95% in 5 years' time? So fairly even spread there. About the same as now. It's a bit more for about the same as now. Between 90 and 95%, so increasing marginally. Okay. Oh, here we go. Brilliant. Didn't have to check my counting ability. So that looked to cover, that was looking like that as people raise their hands for the first couple of questions. So about the same as now, 49%. So there's a clear lead there. And then not much change down to C. Less than 80% has got the lowest response. Okay, so that's really interesting. So people think it will stay about the same as now. There's mixed views on whether it's good or bad. So I think, Shri, if we could kick off with you in terms of what you feel that means in terms of technology, personalisation, those kind of issues.
I quite like the tale of optimism in those as well, because there was quite a lot of people that thought it will go down. But that aside, without looking at sort of crystal ball gazing, we are where we are with a lot of people. I think, was it 99% in your research so far?
Yeah.
Being in the default. And I know my peers are going to be talking about how you structure the investment side of things. But what I wanted to talk about is how are defaults structured now? By and large, the majority of our lifestyle strategies, glide paths of some kind. And they're all based on a single parameter, age. Which seems really bizarre in the age of data when we know so much about members that we're only using a single data point. And if two people share that data point, they're in exactly the same fund, regardless of circumstances. Having seen what different schemes are doing and what different trustees do, I've noticed that a lot of people try to get a bit more granular, but it's just operationally complex to administer. So, for example, I've seen schemes who have a DB cohort, try to isolate the members and put them in a slightly different default, which by virtue of a default you can only have one, but okay, well, you know, there's lots of segmentation that tries to work, but the problem is it can be done at a point in time, and member statuses change. There's also very limited choice being offered when it comes to lifestyle strategies. So the default just offers a single point of a single growth and a single end target. And some schemes who try to veer away from that end up incurring a lot of administration costs to introduce that as well. So personalization isn't really happening right now. It's just the one choice for everyone. It's kind of like telling my tailor, here's my height, here's my weight, tailor me a suit. It might fit someone, but it's unlikely to fit everyone. With that in mind, we are at an age where technology is just rife, and we can use multiple data points to build something that is a lot more tailored to each individual. What I'm talking about is, so we have age, we have fund balance, we have salary levels, we have contribution levels, all of which, if you look at the different data permutations, lead to each member's circumstances differing quite vastly and requiring different investment strategies. As trustees, as decision makers, I know that we're very familiar with how to design default strategies, but we're just doing it with one person in mind. I think more often than not, we just use the average member, the average salary, the average pot size, and then we base an entire strategy on that. I'm sure I'm seeing a couple of head nods, familiar with that decision-making process every 3 years when you review your strategy. So we look at those metrics and we go, okay, based on this, we should need to have this type of growth characteristic going into this type of decumulation endpoint. Now let's step away from that, and rather than just making the decision on one example member, because when you design for everyone, you're basically designing for no one, and let's actually try to design a set of rules and let the technology do the hard, heavy lifting to then apply that across your entire membership. So that stat of 99%, I think I'm one of the optimists who would have voted for it to go down, because I think the defaults of the future will be one that looks at the data and puts members in the right fund based on their circumstances. So you're not going to see everyone in just the one lifestyle. It's going to be a lovely blend of different lifestyles, each personalized for the key cohorts of membership.
So with the true personalised default, would you feel it was an optimistic thing to hope that 100% of members would go into that if it was truly personalised, truly default?
Well, I mean, 99% of people would just end up in there anyway, won't they? So I don't have to work harder to convince the other one to switch from self-select. But I think what you'll find is, and I've been looking at the research around this, that when you prod people a certain way that there's a certain personalization and customization of something, it leads to better user experience. Let's talk about Netflix or Spotify. You're getting amazing consumer experiences when you personalize something and higher levels of engagement. We haven't done it in pensions. We certainly haven't done it with investments. It remains to be seen.
Okay. Brian, can I bring you in at this point in terms of what's happening in the landscape at the moment and the whole question of engagement and defaults?
Yeah, so I guess picking up from some of Shri's points there, because it is quite interesting that auto-enrollment's been such an unmitigated success, and yet 99% of people are in the default. So whilst auto-enrollment's been a success, would you say engagement's been high? And I would challenge that perhaps and say, perhaps if you can engage more, people will take more interest, etc. But at the moment, they're clearly just going with the flow. So Shri got me thinking there that if you could design a range of growth funds, for example, that were trying to beat inflation by 3 to 5%, but they all had something different in characteristics that people might align with. So you might have a growth fund that's aligned with technology or climate or gender, whatever it is. Then you might find that whilst people would go into these vehicles, they'd go in because they were engaged and they felt that they were more relevant to them. Anyway, that's maybe pie in the sky, but there has to be some kind of connection that get people back involved and interested with this stuff. And I guess at the moment we're seeing quite a lot of interest in people's pensions, given what's going on. And I just thought it may be worthwhile touching on that, because I don't know if it's coming up anywhere in the conference. But we're looking at certainly equity returns. The all shares down at levels now that it was at the end of 2015, 16, beginning of 16. So we've basically just lost 4 years of returns as a result of what's going on at the moment, and that could go further back, of course. So when we're looking at defaults, I guess my big concern is people that are about to retire. I mean, what are the implications on the default? Have they got the strategies? Have they been working? And what position are they in? And so there's some work doing that. So we're doing some work on that at the moment. But I'm pretty sure I know what the answers will be. That off of the back of a very strong bull run, equity markets have been very, very strong. We've seen them come back down again. But 100 quid invested, 10 years ago is still going to be in the money right now. If it was in equities, if you're in a glide path that's going to annuities, you're really in the money actually, because you've come out of a very strong run and you're now flipping into assets. You've been buying assets that are going up in value. Cash, you're in a pretty reasonable position if you're going to hold it as cash. And then drawdown's the one that's maybe up for grabs, but I think even with drawdown, which will still have quite a high equity content, it's a long-term vehicle. It's a 20, 30-year time horizon, so people have got time on their side. So I think on the whole, from a strategic perspective, and I go back to the same message we had in 2008, and it is very different to 2008. But the comparison of, have these strategies worked in times of stress? Because at the moment we're going through a really heavy governance stress around investment, communication, and governance itself. Actually, we're really stressing it in every manageable possible way at the moment, and the defaults will be part of that. But if you look at it and see how the defaults themselves have worked, they've probably done okay for somebody that's been investing for a long term. So I think that's a message that's maybe not getting out there at the moment, and it's just something I think we can, as a group, spend more time on. I'll just last little point about the investments. There are lots of nice things happening in investments themselves, and we are, obviously with climate and private markets, equity, debt. And the stuff that's going on with the British Business Bank, infrastructure. There's quite a long list of things stuff that are going into defaults and investments generally. I go back to the good old DGFs, and for years we're going, hang in there, because one day the markets will crash and these things will keep us right. And a number of folk have probably lost faith in them and tried to do other things. But I guess a lot of trustees, if you're in the room and you've got diversified funds, you'll be hoping that's your get out of jail card at the moment for your members. And so we'll need to see how that maps out over. So there's a lot of these things we put in play to bellwether the investment strategies that should now start to be helping. So that was like a random walkthrough today. That's all right.
No, it's really helpful. We're getting quite a few questions coming through on the app, but David, could I come to you next in terms of your view on default strategy, number of members in there, government perspective, government ambition?
Ooh, well, okay. I was going to my personal view. Forgot I was speaking for the government. I think probably from a government perspective, we're pretty happy with if the percentage of people staying in the default remains roughly the same. I think I'd get slightly. I think whether we'd be concerned if the numbers dropped. It depends on what they're dropping and why they're dropping and what people are moving to. I think the worst thing that we can have happen, and I think this is hopefully relatively rare now, is for people to be, you know, to join the pension scheme, to have the trustees and the administrators shouting at them, saying, engage, engage, choose an active fund now, you know, and then they choose something which is whose choice is entirely dependent on them having to constantly review and revisit that choice, because they quite possibly won't do that, and that's where we'll find ourselves with people who are 100% engaged in equities around now, maybe, and looking at retirement, and those are really quite hazardous positions to be in. So if we are going to be looking at alternatives, you know, at trying to encourage people to engage and not have to constantly revisit their decisions, then I guess what we're looking at is things like defaults with a range of risk levels. I still get kind of slightly worried at this point, because I still just think I'm not 100% sure that members are very good at judging their own risk appetite for risk, and that they might systematically underestimate that. And it kind of needs a trustee to kind of nudge them and say, actually, you should be taking a bit more risk than that, and to try and warn people who are kind of veering towards away from the equities that sound scary and towards the cash, to say this really won't be enough. So I suppose those would be kind of initial reflections. I mean, you know, Shri's model kind of sounds like interesting and you know, and something that it's, you know, let 1,000 flowers bloom and let's try these things. But I suppose my concern is always going to be a little bit that you can allow for some demographics, you can model people roughly on things like pot size and gender and age and those kinds of things. But there's going to be loads of information missing, so you won't know what their historic pots, you know, that they've got from other pensions are. So you don't really know their full appetite. And in terms of, you know, I don't know if anybody's doing this, but if people like steer men towards higher risk and women towards lower risk because that's the way they report themselves, it's kind of like they've still got the same income needs in retirement. And actually what you're still looking at is a massive spread of people who, you know, with very widely dispersed views, who just hit an average that's slightly apart from one another. So if you just try and map people in a kind of they've got a pot size of this, you know, they've got this amount, then you're kind of using very noisy proxies that won't turn out to necessarily accurately reflect what the members you know, would do if they're in a position of full information and full knowledge about stuff. That said, I totally agree on the decumulation point, and I think, you know, we ought to be looking at trying to encourage people to engage as they enter the glide path, to actually think about what, you know, what kind of product they want to enter. And then finally, I had a final point. Oh yeah, it's just that kind of, you know, the kind of long run of pension saving has often been, you know, let's get people to engage. Let's get people to voluntarily choose pension saving. It's sometime in the mid-noughties we say, okay, that's not working anymore. Let's do AE. And it's kind of, now we've got AE and that's working. We're all kind of going, okay, so how are we going to make people engage? And it's kind of like, it's not necessarily a problem that people don't engage for large parts of their saving period. It's important that they engage at certain times, especially in the run-up to retirement. But I just think let's not thrash, you know, flog ourselves or beat ourselves up about the fact that we're really trying hard to make people engage, and a lot of people don't necessarily want to. When people are ready, then some of them will.
Mm. That's really interesting. I think, Brian, you've
Sorry,
come in at that point.
you're right.
Yeah.
But, no.
We said this would be slightly heated fireside chat.
No, you're right. You're absolutely right. But the two things we really struggle with is how and when.
Yeah.
Mm-hmm.
Right. And so when we talk about engagement, I'm not necessarily saying we need to work. You're right about the investment side. Mm-hmm. The investment, I don't think, actually, despite what's happening at the moment, I don't think is the biggest challenge. Mm-hmm. I think the other challenges sit outside of that, and the how and the when are the two things we can never get members to get their heads around. And you know, what's your pension? What's it going to look like? And get yourself pointed in the right direction. So, yeah, there's engagement. I don't think it has to be investment. I think it has to be in some other area. Sorry, just
sure. No, agreed.
And just to kind of share a flavour of some of the questions coming through in the app, I don't think we've got time to answer them all, but we've got some people very interested in what Shri's been talking about and thinking about how does that work with certain other disclosures, are there risks around liabilities, innovation versus legal action, how does this work with disclosure in the chair's statement, but also opportunities. So how can you could potentially build in career breaks for caring responsibilities and some of that personalised data, personalised defaults, questions around are Spotify, Netflix good models to follow. But then one of the key things is around at what point does increased engagement become too much of a good thing? So I think this is where there's a big debate over investment and engagement in terms of people kind of reacting to the market in a way that isn't in their long-term interest, and hence the kind of the value of the default. But the idea of a personalised default based on data that's available to schemes is a really interesting one. So I think we've also kind of mentioned decumulation in some of this conversation as well, and we've got a couple of polling questions that might be handy to move on to now, to kind of look at the decumulation question and how we can weave some of those thoughts and ideas into what's happening now, what we think should happen in the future, and what are the challenges and barriers in relation to those things. So the next question is, where occupational schemes offer drawdown, do you think they should offer investment pathways? So I'm going to assume that in this question that came through from the panel members that we mean the FCA investment pathway specifically. So if you could answer the question in that regard. And it's working quite quickly this time, which is fantastic. So that's very interesting. You give it a few moments to see if it changes again.
Wow.
Is that the Willis Towers Watson logo?
So, okay. This is very, very interesting. So we seem to be settling on a large majority thinking that the scheme should be required to offer the pathways or explain why not. And then drops dramatically down to they should be required to, and then much less on the no, they should be doing something different, which is really, really interesting. So I'm going to move on to the next question. So this is more in terms of the kind of product space and managing risk. So are you happy with people's pension pots being annuitised at, say, 80? So if there was to be a proposal that people should annuitise as they go towards later life, what do you think of that? Again,
Not very strong views.
Well, it sounds
Yes, but not all of their savings, and members should be able to opt out, is in the lead. Mandatory annuitisation is coming very low.
So partial mandatory annuitisation, I
So
think, by the looks of it.
Default annuitisation.
Okay. So there should be is a clear no. They shouldn't be is middling. And then the leader is yes, but not all of the savings. Okay. Okay. So if I can come back around the panel in the opposite direction, maybe.
Right.
Brian, pick on you first in terms of decumulation.
So the two things there, I guess. So the first one was pathways, and I'm aligned with that. I thought I like pathways. I think it's a good idea. The whole concept that 99% of people are in defaults and then they retire, and the next day they suddenly know how to make investment decisions, just doesn't seem right to me. So, and I think pathways should start a good few years before retirement, 8 years or whatever it is, and they just flow through, and there's no frictional stuff as people leave, all that kind of, out of market exposures and all that kind of good stuff. So I think pathways are good, and I could see building blocks of pathways in my head if I was retiring, how you could add these together to get kind of, your own lifestyle lined up against that. So I'm kind of a fan. The 80% annuity, the annuitisation at 80, and I'm thinking about my mum at the moment who's 86 and dementia in a care home, and if she'd been forced into annuitise, that would have been a bad place to be for her. And so I think this whole area needs a lot of thought. I mean, there's the piece about the longevity piece, particularly in DC, and then when you get up to your 80s and you're 85, and the experience we get from our Australian colleagues is, whilst you draw down and you go and see your provider every year, and they talk about how much do you want to draw down this year and what rate and all that stuff, people get bored of that after a while. So I can fully understand when you get to 80, you need to have something in play. There's a point around about this about demand and pricing, and those will determine whether this can work or not. And I think people are absolutely right to say you should be able to opt out of it, but there will be circumstances where it will be just wholly wrong. And so I think there's probably scope to have some kind of industry group looking at this just to see kind of what flies and what doesn't fly, rather than being product led, because that can force us down a certain route. So I'm just putting out there that there's scope to have a grown-up conversation around about this. The other thing is, if you're sorry, just one last little point. if you're in your 50s or 60s and somebody says, right, you've got to put a big slug of your money aside to do this when you get onto later life, that's not in line with what's happening in the market right now. And so there's a disconnect with that. If you look at drawdown, what's actually happening, it was the FCA maybe came out with this, what's actually happening is people are taking a tax-free cash lump sums and then they're deferring retirement. That's kind of what's happening. So if you're trying to introduce, or park away, put money aside for later, then it's quite at odds. But it should be looked at. That would be my observation.
Okay, Shri?
I mean, the point I was going to make is there is a group looking at that. It's the Money and Advice Pension Services Challenge Group's Future Focus work stream, I think. And they're looking at decumulation.
Absolutely, and PLSA is doing some work as well on the kind of decumulation and looking at kind of a number of different things, including, what's the best way of looking after members who don't engage or are unable to engage? What's the safest path for them? And that's not to say that people shouldn't be seeking to engage members and trying to get them to engage with it, but it's kind of the other side of the default strategy and the challenges that the pensions freedoms have brought to that whole environment. So on mentioning that, I might just now turn to David.
Sure,
I know your views on decumulation.
Yeah. So I asked for those two questions, and thank you very much for the helpful research, the kind of input that it's built to our ongoing policy work in this area. In terms of obviously. People will be aware that there are no mandatory pathways legislation in relation to occupational DC at the moment, even though FCAs are up and running. I guess our rationale for that has been that there hasn't been a huge amount of in-scheme drawdown in DC. Where it is being offered is tending to be offered by large pension schemes, but with many of the members with relatively small pots. But we recognise that is changing quite fast with things like consolidation into consultant-led master trusts, who are understandably keen to kind of keep the money in retirement rather than push people over to a GPP or a SIP or whatever in decumulation. We've got some catching up to do. It's kind of like the market has moved on, and DWP needs to kind of decide whether there is an issue here, or whether this is going to naturally evolve, whether we're going to get defaults. Sorry?
We can help you with that.
Yeah. Whether we need defaults or whether, and certainly we'd welcome that, or whether this stuff is just going to happen organically. I mean, certainly it feels like a no-brainer to me that the kind of solutions that everyone needs to take financial advice and stuff are just utopian. Really, that isn't going to work. And so there is a need for defaults. The question is whether we legislate for them. In terms of the default annuitisation at a certain age, I mean, I guess that probably lands more or less where, A, where I'd expect it, and B, probably where we think it should. That it feels it does start to feel a bit like an appropriation. When a member hasn't made any active choice at all to kind of mandate them into an annuity, one feels like there have to be certain rights of opt-out in that stuff. That you start thinking about property rights and Article 1, Protocol 1 kind of consideration. So, but obviously we are aware of cognitive decline, in the way that Brian's talked about it. So. I think this kind of stuff is going to emerge organically again through the FCA default retirement, investment pathways. These are the kinds of options that that will, the kinds of products that will be put into place when the current crop of people who are going into these things hit their 70s and 80s. So again, our default as DWP is that we try to stay aligned with the FCA on these matters, unless there are compelling reasons to the contrary. We'll be doing some policy work over the next few months to try and think these things through, and I'd expect us to be at the very least reaching out to lots of pension schemes and lots of other advisors about this stuff, and potentially doing public consultations this year on that, on the idea of replicating the FCA's model in occupational schemes.
Just a quick word from the sort of PLSA perspective. So as I mentioned, we're doing some work on decumulation. We're talking across the DWP at the moment. So trying to look at this kind of whole default kind of set of options and how that might work. Obviously, the things we need to bear in mind as well is that members will have pensions across the landscape. They won't necessarily just be saving with one side. So it's how do you make that work for members in a way that doesn't put them off from engaging, doesn't scare them off, but enables them to find a safe path through. And I think there's kind of some great things that the trust-based sector can be doing in that space. And obviously with the growth of master trusts as well, and potentially looking at decumulation options in that arena, and thinking about how the market might move forward in that respect, as well as obviously obviously the ongoing growth of funds and needing to future-proof for the pots as they go through there. So that's all interesting stuff, but yet to come. We have only a few minutes left for the rest of the session. So we've had a couple of questions in on the app in relation to accumulation. I think a couple of them I can summarise as observations. So the challenge of having a single age for requiring people to buy an annuity, the challenges of different life expectancies, and therefore how would you factor that in? Whether or not the dashboard will help people with the decumulation process in terms of their awareness and being able to track pots and that kind of thing. Also, whether will it change the default landscape as well. So I'm going to pause there on those questions and skip now into the final set of polling questions, which is focused on ESG. So we've had answers already. It's very efficient. So what are the next big steps for defaults in climate change and ESG? So we've got 5 possible answers. Okay, so members' views, member panels, member meetings, should there be more of those? More engagement, more radical tilting, personalising defaults to reflect member preferences.
It was in the lead just now, I just saw it drop. That was
Reporting on Paris alignment with temperature scenarios.
There we go.
Okay. Woo. Okay, just counting down to the last few. Okay, I think if we leap off from there in terms of observations from the panel, and David, can I come to you first on this occasion?
I'm just furiously writing down those details, you know. All of this is a valid
as
contribution to consultations. Go engagement and voting. We're going to get Caroline Escott at the PLSA to end all work on that because trustees clearly don't think, or people in this room don't think that is a growth area. Anyway, it started out very surprisingly, and it's kind of it's moved back more to where I expected. You know, personalising defaults does feel like, you know, a broadly sensible thing to do, but it's not some stuff that government will be kind of nudging or encouraging people, you know, to value that over the kind of one-size-fits-all default that you'd see at People's or Nest. Reporting on Paris alignment is clearly something that government, you know, is also interested in, because we just see that as a really kind of compelling way of communicating, you know, climate risk to members. You know, what's the temperature rise embedded in the, you know, in the pension pot that I have. That does feel like a potential engagement tool, or potentially a disengagement tool, or potentially a kind of members going and shouting at trustees type tool. We don't have an intention to kind of move very rapidly towards this, because we simply don't know, there aren't robust ways of doing this. And our experience, I think I've heard about in France, where certain, I can't remember, it's the French climate reporting law, where they've got banks and insurers and people like that doing this kind of reporting. And there have been people with identical portfolios who've reported temperature rises of 4.2 degrees or 2.1 degrees based on, you know, exactly the same asset allocations, but radically different models for identifying it. But it's certainly something we're interested in taking forward. The voting, I just think DBP, continues to make noises about this, and our ministers, continue to make noises about this. But we do recognise this is really hard, and so I suppose there is a realisation that's going to be something which comes further down the road when we've had more consolidation, more assets being directly held rather than being intermediated via, potentially via a platform, a fund manager, an underlying fund manager, and so forth. And so clearly it will develop as we move towards our 5 schemes with more than 20 billion of assets, or whatever it is that we were predicted this morning. I'm just conscious that I keep giving really long answers, so I'm just going to stop there.
No, very helpful.
Okay, right.
Brian, can I come to you?
Yeah. So I just had one little thing. As an asset owner looking at fund managers on the reporting side, which is kind of the last point broadly, it's quite hard to look in and get a level playing field and be able to judge not just climate, but ESG and responsible investment generally. So the CFA have set up a global group to look at this. So I'm on that group, and the plan is that in the same way as you have global investment performance standard reporting when somebody pitches their wares to you, there'll be an equivalent of that for, ESG, but broader than that will be climate and responsible investment as an umbrella term. And I think that'll make a difference, but I can just see it's going to take a bit of time for that to, because there are, you mentioned the French guys, but we've got the ABI, we've got everybody involved in different groups trying to sort of pull this together. I think the CFA will be a good one because it will go straight to the fund managers and then they will all kind of pull into line.
Agreed.
And I think that will really raise the game here because it's really pretty hard at the moment to try and, you know, assess. So I'm aligned with that last point.
Okay.
And I am aligned actually with the second last point of having, as I say, flavours of default and defaults that are more aligned to people's beliefs and attitudes.
Cool. Thank you, Shri.
Well, if I can quickly address some of those questions on the liability and also picking up on some of David's points. It's something that trustees already do. Like, they will profile their membership and pick something based on just a few characteristics. You're familiar with making the rules around that. Why not just apply it across the membership rather than just being forcing everyone into this one-size-fits-all approach? I like the idea that people are pushing for the Paris Agreement and temperature disclosures, because talk to members about something that they know about. So that's something that I'm very supportive over, and I think Guy Openman said this morning that it's likely some kind of solution will emerge that just is aligned to that, and most small schemes would end up investing in it. So that could be the way that defaults go forward. But yeah, when it comes to personalization, I think if you're going to take those decisions now anyway, imagine doing it at a much better level, much granular detail. I think it's less risky to do that than it is to just say, here's one example member, no one really, and broad brush them all.
Interesting. Yeah, brilliant. Okay, so I'm afraid I'm going to have to draw the discussion to a close. It's been really, really interesting. I think we've covered a lot of ground and covered a lot of issues. Obviously, still lots more work to come, lots more answers that are needed. Very interesting area. So can I just ask you to thank the panel in the normal way?